I'm the principal broker and president of the Sunbelt Business Advisor, Greater Bay Area. And the presenter today is John LaMay, one of our senior advisors at our office. So why Sunbelt? So we understand you have many choices when it comes to sell your business. You can work with many different advisors, but why Sunbelt? So Sunbelt actually has the largest business listing database. So at any given time, we have about 3 billion listings active. And also Sunbelt has more, over 1 million listings than any other brokers. We also have the largest proprietary listing and buyer database. Sunbelt actually started in 1970s, so the franchise has over 40 years experience in doing this business, advising business owners. And also for our office, we're right in the heart of the Silicon Valley. Our office is in Sunnyvale, and we have been serving the Greater Bay Area and California for over 20 years. All of our agents are experienced. They either come from a previous ownership, they own the business themselves, and also they might be corporate executives. So they all are very seasoned advisors. And also the key important thing for our office is that we align our interest with your requirement. So every deal is different. We're going to adjust every deal according to the client's needs. So our marketing process, our advisors, and our process is the best. So that's what I like to say about the Sunbelt. And also next, probably a little bit about John. So prior to joining our office, John has over 30 years of successful management, engineering, and acquisition experience from large international technology company. And since he joined us, he's been working with various business owners, including manufacturing, engineering, distribution, retail, and some service-based businesses. So in the last 3 years, John probably closed about maybe over 20 listings. So you can see that's a very impressive number. And we also have some testimonials listed here. I'm not going to go through the details, but we're happy to distribute the presentation after the webinar, so you can see, all the good feedback clients have about John LaMay. So with that said, I'm going to turn over the presentation to John.
Good morning. Can you hear me okay?
Yes.
Okay. Good morning. Welcome to our seminar. I just really like to say I have an engineering background in the 2000s. I was my first exposure to some M&A level activity with a big manufacturing company that I was working for. And over time, I've been invested in different parts of that over the last 30 years. And even in the last 5 years, I'm really proud to be associated with Sunbelt. I don't see myself as a salesman. I see myself as a problem solver. And really, that's what you really want in an advisor, not somebody who's going to tell you. They're going to advise you educate you on how to solve problems. And that's what I'm excited about this webinar, to go into some different areas. And you're always welcome to call me or email me for follow-up, or the office for any follow-up questions or clarifications on anything. I will leave time for question and answers. Put it in the Q&A area. Some people put it in the chat versus Q&A. Try to put it in the Q&A for JC. We received a few questions that people had given us in advance when they registered. We'll work to address them. There's a lot of material in a short period of time. So let me just start off with one thing, just as a funny. What is the plural? There's people on this webinar from all around the area. What is the plural of y'all? Does anybody know what the plural of y'all is? It's a more of a Southern or Texas type term. Some of the Northerners say you'ns and stuff. Well, a good friend of mine, and she was really good into potlucks and gathering, she'd say, all y'all come over here. That's the plural of y'all, is all y'all come over here. So just so you know that. So really, one thing we do need to do is just to have one slide on a disclaimer. And it's really, we are not, I'll let you look at this slide for just a moment as to who should advise. And you can see that there's attorneys, CPAs, brokers, advisors. Broker advisors, sometimes they're called intermediaries, M&A advisors, brokers, advisors. Appraisers have their own niche, lenders, escrow. And really for a business sale transaction to be successful, you want to have experienced folks within their niche that say discipline, solve your problems where they can anticipate your needs and advise versus sell, and lead you through the process like a quarterback. It can be a very complex process, just like building your own business is a very unique set of complexities that we don't understand all. But we're not licensed or qualified to provide legal, accounting, or tax advice. And you can read the disclaimer there. But in this presentation, we're not advising on your specific case, but we're sharing common information in some scenarios. And if you seek additional information or clarity, just reach out to us for a free consultation. We're glad to. So there we go. So very good, Benjamin, all y'all. So here we go.
Now, before you get started, John, I do want to make one more note, folks. At the end of this webinar, you will receive a link to the recording and also a copy of the presentation. So if we're going over a lot of material and there's a lot of script on the screen, just bear in mind that you will receive a copy at the end. So all the information you see, you take notes if you like, but also feel comfortable that you'll receive everything that you see here today.
And feel free to just type a question in. We'll get to it when we can. So here we go. So really, we're going to talk about, we're going to start off with a lot of our webinars nowadays is COVID-19. They just want to update. We're not going to dwell on that. People want to know, is it buyer's market, seller's market? Can we sell a business? We'll go through that, talk about a typical deal timeline that you're probably already aware of in general, some of the market prices for the specific section of business that we're targeting and why they're not selling, and then open up for you guys. It's your webinar. So here we go. If you look over on, this is a chart from BizBuySell, nationally recognized data for closed small business transactions. And you can see down in Q2, it dipped down to significant dip, 1,481 transactions from 2,225 in the previous quarter in that Q1. April had a 51% decline, but it actually came back in September to about a 5% year-over-year decline. So what we're seeing is buyers are excited about getting SBA loan terms where the interest rate's under 6%. And a lot of buyers are thinking that Congress may actually pass a CARES Act sometime to extend the SBA program for additional SBA paying the first 6 months of loan principal and interest. So stay tuned. We'll see what happens after the election. So another, I'm going a little quick on the COVID-19. Feel free to put questions in as you like, and we can deal with it later. Yes, the transition from a seller's market to a buyer's market starting around Q1. And there's a lot of buyers looking out there for deals, and there's some who are looking for pandemic-proof businesses. And that's really what we see right now. Really, if you look at this chart here, it shows the median financials over time, and you look at the recent change. The median revenue went up for some of these businesses that were sold. People moving forward with pandemic resilient businesses. Many of those deals that were in queue and in Q2, Q1, they went on hold or went away until people got to see what is the new normal. What does that mean for us? Median cash flows had a slight change, but it's just a testament to the resilient, a little bit of a V-shaped curve, and we'll look at a little bit more data into that. This is the small business sales by sector, percent of transactions that closed in Q3, and there were 30% more restaurants. You know, same median price, 35% gain in service transaction for service business. Retail, a lot of people stepped away from retail. A lot of things were closed. Things got back together. They're seeing with the retail, there were some essential businesses did well, and they really gained in transactions in Q2, with manufacturing actually doing about twice the amount of deals. It's a smaller sample size, you know, at 5%, but it was a good rebound. So let's see here, COVID-19. This is a chart showing key metric by the sales price of the deal. And the blue line represents all businesses that are sold, that was reported on BizBuy. And the orange line represents those businesses where the deal size was over $1 million. Maybe they had 300 or 400,000 in net income or seller discretionary earnings, which we'll touch on. We'll talk through that. But the higher performing businesses, you look at the deal size, they got about a 40% higher cash flow multiple. If you look at that, you see that 2.41. That's what the deal price was for businesses that, you know, all sold businesses with 2.41. But those that were deal size was over $1 million, their multiple was 3.4, which was incredible. And the sales to asking price on the bottom, there was a 5 to 7% discount from the asking price versus the actual close price. So I just thought you might be interested in some of that data. And let's get back into, that's just a brief COVID update. Feel free, we'll follow up later. Let's talk about the deal timeline. Go ahead.
John, I'll ask a question. So you talked about maybe the COVID's impact on the volume and the sales price of the sales. How about the deal structure? Has COVID-19 impacted how deals are structured before COVID versus after COVID?
Yes, it's in several ways. That's a great question. A few key points are you know, they're looking at how well is the business performing going forward? What's the new normal? How different is what it looks like now versus maybe you had a rough quarter or two that you had to put through. So just really looking to normalize that out. Where there's value gaps, there may be more deals where the sellers are taking what they call our earn-out. So if there's a gap in value between what the seller wants and what the buyer is willing to pay, and it's based on some future performance or something that's a little risky, there may be an earn-out that based on achieving that, the seller may get more additional funds for the deal. The other thing is I know that with lenders, with the deals, they're very careful to understand year to date, 2019 versus 2020, what the last quarter is, just with all the details. Just from a risk standpoint, it's pretty key. We see a little bit more seller carry. The majority of business deals actually have a seller carry note. That's where the seller is partially financing. It shows to lenders and buyers somewhat they have a little bit of skin in the game. If it's by 10%, it helps with the transition, and it's a good thing. Some deals the sellers may, for various reasons, could be tax consequences, retirement. Some of them may finance 50% of the deal. It really depends on the specifics, and we advise you to get specific advice from ourselves, your accountant, and your attorney, and those types of things. But thank you, Ellen.
Yeah.
Thank you for that.
Sure.
I also, John, I do see some questions coming in. I just want to ask the audience if there are any COVID related questions, feel free again to ask those now.
Okay. So I'm going to go ahead and I'll catch up. I'll let that catch up. I see a few there. Let's talk about the industry data. What percent of the businesses I probably already showed the answer here, going to the slide a little faster. What percent of small businesses sell in the first 12 months? Let's just take BizBuy data right now. What percent of businesses that are for sale actually sell within the first 12 months? Does anybody in any of the participants want to just put a number out? Is it 60%, 7%, 20, 30, 50? Put a number out there. It was surprising to me that the success rate is only 20%, less than 20% of those businesses that are marketed online actually sell. There are some businesses that are not marketed online that have a little bit different numbers, but in general, this is the number. And of those that do sell, 50% of the sellers made significant concessions based on the advertised price and terms. And really, it really, our office sells over 70% of the listings that we take. And and we don't take all the listings. There may be different preparation that some business owners need to do for 3 months or 6 months or a year or 2 years to make it more marketable, to get a higher return and be able to sell it in a faster period of time. That's our goal. So let's just talk a little bit about how long it takes to sell a business. This is broken up into 4 columns with prior to taking a listing, a couple months for marketing, 4 months for broker screening, 2 to 3 months to close the deal through closing, once the buyer feels it's the right business for them from an offer. And really, if the business is priced at market price and terms, it probably won't sell, or it'll stay stuck in the I don't know what's happening. Let's say the business won't. Sorry about that. That slide went ahead. The screen stuck. Is that on the deal timeline? It talks about it. It says if a business opportunity is not priced at market terms, it may be stuck in that third column for a long while, that 1 to 4 months. So let's talk about market price a little bit. That's really key, and it's something you can be doing today to make a difference. So let's look at that. The small business market price. This is just one aspect of many. For most profitable businesses, it's influenced heavily by what we call the seller discretionary earnings. Now, I just want to point out that this presentation is geared towards profitable businesses. If you're not making money, you're distressed, there's a different set of requirements. There's some profitable businesses that may be influenced a little bit heavier by other data, but in general, it's heavily influenced by the seller discretionary earnings, which helps set the return of the investment and the return on the investment. And really, seller discretionary earnings is a financial benefit that a full-time owner operator might realize. So it could be net income, whatever salary you're being paid, depreciation, amortization, interest. These things could be added back. And there might be some owner perk add backs or some wage or expense adjustments that make sense. But in general, lenders and buyers look at 3 years of recent performance, based on tax returns and year-to-date data. And some of the year-to-date data, we can talk about what's being carved out or not because of the COVID, but just in general, it's very key. One thing that we see is these SDE multiples, say it's $200,000 or $300,000 or $500,000. The business value can range from 1 to 4 times the weighted seller discretionary earnings, where the most recent historical performance is weighted heavier than 3 years ago. The EBITDA is earnings before interest, tax, depreciation, and amortization. And that's really is approximated by the seller discretionary earning less the GM or the owner's salary. And those multiples are much higher, typically between 2 to 7. Some strategic players will play at the high level or above, and some others will be at the lower level. And really, this on the market price is, say, the market sets the price. And really, that's why we heavily encourage getting a third-party market appraisal, or a that really finds out some of the value, maybe some of the nuances in the business that affect value and risk, which affects the market price, and what buyers would be willing to pay, what lenders would be willing to support. So let's talk about the median deal paid by deal size right now, and this is really key. So the horizontal axis, where it says 500,000, 500K, is a $500,000 transaction that closed. If it was making $250,000 in seller discretionary earnings, the multiple may be 2, so you'd realize 500,000. If the multiple is between 500,000, if the SDE is between 500,000 and 1 million, you can see as you get up towards 1 million and 2 million, the multiple is 3.3, which means that the multiple is more than 50% higher between 2 and 3.3, the first and the third column. And so you're going to, by making the more money, maybe you're making 1.5 million, you're going to have 3 times the cash flow of what you might have 500K, and then maybe 1.5 times. So you may get 4 times more for your business if you're making towards the middle column than you are towards the left column, if that makes sense. And your specific case may be slightly different, but we'll look at that in some detail with some other areas. So really what I'd like to do is, what are the top reasons? If some of it just send to me, why won't a business sell? What do you think would stop a business from selling? What are some of the top reasons? If anybody would know, I see some responses coming to me. There's some others. I just want you to think about that. What is that? Well, this is what it is. EBITDA is, excuse me, I didn't cover this slide. I meant to go over it. But EBITDA multiples are related to the seller discretionary earning. It's just the GM or owner salary is taken out. But these are the top reasons why a business won't sell. And this is from Pepperdine University. They do quarterly and annual surveys over the last several years. And you can see that 33% is because of the seller's unrealistic expectations. Lack of buyer prep is 15. The poor seller prep is 11%. Terms that are not financial is 9%. And personality conflicts, chemistry between the buyer and the seller is another 9%. So, but the good news is over 50% of this is in the seller's control. And really the qualification of the business value with a business lender and a buyer screen will save a lot of false starts if it's handled correctly, and maintain your confidentiality as it is.
Yeah, and John, I just wanted to say, when sellers call in and I explain the process to them, they want to understand how we go about finding buyers. You know, you look at the last one there, personality conflicts. It's important for sellers to know that as Sunbelt business advisors as our team, it's not just finding a financially qualified buyer. It's finding somebody that might have the right experience, but also, of course, making sure that the buyer and seller jive, that when the buyer does take over, the employees are going to like them. That is very important. You know, it's low on the totem pole here on statistics, but it is important and it's part of the process, and we take that into account. So just something good for sellers to know. But I did have a question going back to slide 15. John, you know, you said smaller businesses get, you know, about a 2.0 multiple, somewhere around there, whereas larger businesses earning 1 million or more get 3.3%. Why is it, from your personal experience, and I know you're going off stats, but from your experience, why do you find that buyers are willing to pay a higher multiple for businesses with a higher seller's discretionary earning?
There's several reasons. Maybe the top few would be it's probably lower risk. The business may be well established, been able to survive to be able to grow to that level. It's a lower risk. The other part is if you're making $200,000 a year and there's a large net of buyers who want to bring in a general manager or private equity group or investment bankers, they want to bring in a general manager and they want to work there part-time because they have other businesses. It's a lot easier to afford to put that in if somebody's making 100 or 250,000 and they pay somebody 100,000 as a replacement salary. There's not much left there. If you're up at the 500,000 to the seller discretionary or $1 million of EBITDA in those ranges, then they can go in and replace the GM and still get a good return on their money. So, you know, it's risk and what model it supports. It's very attractive, but everybody, a lot of people want a semi-absentee business with recurring income, low customer concentration, low vendor concentration. And it's not all about John, the business. We talk about businesses where it's all about John. If you've had to grow it to that level, you probably have your management, some of your employees have the right certifications you've passed on rather than just your license or your certification. And I'd be glad to address that in detail later. Thank you.
Thank you, John.
So we've got, I see some of the reasons why they won't sell, but look at this. Let's watch this here. Let's see some of the deals. Lease rates, net proceeds, deal breakers, let's see. So I'm gonna just camp on this slide. There's a lot of reasons here. These are just some reasons. It's not all the reasons. You can see the buyer qualification change before escrow, lacks recurring income, agreements heavily slanted. You'll get a copy of this. It's just you get a lot of hurdles get thrown at you while you're marketing your business and while the deal, even if you've agreed to it prior to closing. And these need to be solved. There's best practices to solve them that your trusted advisors can help manage you and help you. And there's preparation you can do in advance to mitigate these from being a real biggie, because like everyone knows, time and surprises kills deals. So get it done. So every deal has its own personality, but our job is to break this out into areas that make sense and come up with solutions. We're here to solve problems, and we've got trusted advisors who work with us to solve. So when we look at this, let's just break this down and break it up into a few overlapping areas of value, terms, and risk. So let's look at value first. And now as I look at this, value, there's nothing like independent market appraisal or comparable analysis to understand what is the market price, not maybe what we as a seller want, or we as a what the buyer would pay. Let's just figure out what the market price is and substantiate that. We don't want to leave tens or hundreds of thousands of dollars on the table. Appraisals, we deal with national appraisal companies. They can be $3,500 or more. Sometimes a comparable analysis or analysis of probable selling price could be half that or so. So, you know, we see that, what are some other things? Market appraisal, business value weighted on a 3-year earnings performance. Let me give you an example of a deal breaker. You know, earnings are recognized on taxes and P&L with reported tax income with some adjustments. Some sellers will minimize income tax by expensing discretionary items, and the lender or the buyer may not recognize that as an add back to service debt coverage, what's left over to pay the loan on a business. They do this to save 40% or so maybe in income taxes for that taxable year. But as we saw, the multiples were maybe could be 2 or 3 or 4 or a higher number on the multiple of earnings. So you may do that, but it may be short-sighted, where you may want to, and if you're thinking about selling in the next few years, or even if you've completed the year and haven't filed your taxes, you may want to work with your accountant and look, maybe don't put these as discretionary expenses that get to business, put it against owner draw. That's what one seller did to get the higher multiple. He felt it was a good return, and they did this when able to close the deal where multiple lenders were supporting it. It was a great deal. So be very conscious of that is all I'm saying. Now, let's see. I see a question. I'm going to wait till I get to the next part on this. We talked about value. Let's talk about terms. If the buyer or the seller is not motivated, a deal usually won't work. It's got to be. We want to find out why the buyer is buying, why the seller is selling, and what are they going to do next. You know, what's the seller going to do after they sell? It's key to know. If we can't get those answers, or if we ask a seller, what price would you sell at? We get a number. Then we'll ask, well, if the market price comes in at a different number, it's slightly lower or some other number, would you still want to sell? We want that answer before we invest all the time and the energy from all parties towards getting this done. So that's seller carry note. The majority of deals have seller carry notes, 10 to 50%. But the buyer needs to have, as far as I'm in Sunbelt concerned, I want to see the buyer have as much skin in the game as the seller at least. And if your advisors aren't experienced in a business sale transaction, you're a very specialist in building your business with your service or your manufacturing, retail, whatever business you have. You're very skilled at that. And you really would want your advisors to be skilled in business sale transactions. Maybe having somebody may just be a divorce attorney who hasn't dealt with commercial lease, with representation, warranties, liability, indemnification, what these agreements mean, or your attorneys don't practice accounting. And we get referrals from lenders, attorneys, accountants all the time to help people sell businesses and advise on the sale of businesses because that's not their expertise. And a well-rounded advisors work with your trusted advisors to make the deal happen. And they need to be deal breakers, not deal makers. Some of the other areas would be reps and warranties could be onerous. personal. I'll let you look at this slide for a second. Give you just a few seconds. I don't know if you ever heard of any of these ideas or not. It makes you think. Some business brokers or business advisors, M&A advisors, they won't co-broke. Well, when we enter into a representation agreement, we're doing that to sell your business for the maximum amount of money in terms. And we don't, if we split the commission with somebody else, we're going to do that because our fiduciary responsibility is to you. Your confidentiality and discretion are important to us. So there's just a lot of areas here with that. I had a deal where the landlord just wasn't going to, just recently, wasn't going to lease to the buyer, and had industry experience, but the seller wanted to be protected too, because the landlord wanted to keep the seller on the hook through the remainder of the base term, which was several years. And so we actually worked it out to where the buyer actually put up a posted funds to be held for the seller if rent wasn't paid in the next 24 months. It was just something as a short term that gave everybody assurities, and nobody lost money, and the buyer got to keep interest on that CD during that time. So let's I've talked about price, I've talked about terms. I see excuse me, okay. I think this question, I don't want to contact my landlord yet, but I'm concerned an attractive long-term lease won't be available to my buyer. Is that a deal killer? Well, if it's a retail business, then it's really key. If it's a service business and the customers aren't coming to the premises or something like that, it's a different deal. But you need to talk with your landlord and find out if somebody's come on there, would they be willing to offer a amenable lease on similar terms to what you have for the extend with options through 10 years, which is the SBA, typical SBA 7A loan term. So it's I would, you'd rather find out now rather than getting somebody down the walk with that. Let's see. On the value thing, something came up. My accountant mentioned my business should be valued much higher. How should I market it? Well, if your accountant advises you to price your business 30% higher than what the third party appraiser has set, and your broker advisor has discussed with you, then I'd say sell that business to your accountant. I think that's what I would see. I think I handled that one. Yes. So let's go to some other areas here.
Hey, John, I just want to remind everybody on the panel, for those of us or everybody who's participating, if you're joining late, at the end of the webinar afterwards, you will receive a link to the recorded webinar as well as a copy of the PDF for this presentation. So feel free to take notes, but everything that's discussed, you will receive a copy after the webinar. Thanks for joining us.
So poor financial records make buyers walk away or run away. I don't see fraud that often. We see misrepresentations. If you say, well, this is a great business and this, that, and the other, and a buyer get buyer remorse or something, you need to let the data speak for themselves and encourage buyers and sellers to work with their attorneys and their accountants and lenders to also from this standpoint. Any material change can kill a deal in the 11th hour, even after spending 6 months to work it through, or 4 months. Make sure that lenders will support the deal and the terms that you're working with prior to getting it out there on the market. That's something that we do. We work with several lenders, and we're glad to do that to just to find out how robust your business is, and that it would support typical financing that they say. Let's see, no long-term lease. I think we talked about that. If the business is all about the seller, it's non-transferable. This is where are the relationships? Where are the seller's relationships with the key customers or key vendors? Is there a high customer or vendor concentration? Is one of them larger than 10%? Those are pretty key. Some lenders will work across most types of businesses, and some lenders are risk adverse to certain types of businesses. So you may get a yes from one and a no from another. That's really key. Yes.
I'd like to add a quick comment about the business is all about the seller. So what we meant here, to be specific, sometimes we have, for example, we had a jeweler who came to us to sell the business. So basically they do customized jewelry, but they are the ones who's doing the customization, they're making the jewelry. So for that kind of business, it's really, that's all about the seller. So because they are their business. If they sell the business, they have to, I mean, all that's available to sell probably is the book of the customers. But the book of customers probably are interested in this specific jeweler's, products, not anybody else's. And there are many examples like this. If the seller is so much involved in the business and every aspect of that about the business is relying on the seller, then that's going to make the sale very difficult. So that's what we're talking about. Business is all about the seller, and you really want to prepare the transition. So ease yourself out of the operation, prepare for the sale. So the business is now relying on you for the most of the operation. So then that way you can, move on to sale.
Right, and piggybacking on that too, also if you're a business where it's yourself, the business is focused on you and the rest of your employees are your family members, that is also going to make it extremely hard to sell your business, and you are going to have to plan on replacing those people before you can sell the business. I just wanted to chime in. It's about 11:48, John, so I just wanted to give you a time indicator there so we can get through these slides and get to the Q&A as well.
That's good. I'll go through a few slides quickly. I see another question. Can you explain how sellers are counting add backs against owner draw so lenders can support? If in the P&L, if the tax return's filed, the P&L and the tax return are a done deal. But if it goes against owner draw, then the net income is higher. It's not treated as an expense against the business. And that's the short answer. And feel free to follow up with me individually for additional data on that. Also, there will be a video link that will be available after the webinar. So I'm going to go through the next few slides quickly and open it up. Just a moment. So in here needs to economic uncertainty. I think we talked about most of these things. There's due diligence. The buyer needs to find out if the business is what they thought it was or what was presented or not. So typically the first few weeks of a deal, a month of a deal, there's a process that we go through to vet that out. And quite often we see if you sell a product and you also have some service required, then that installation typically may require a contractor license. This also could be said of other licensing that service businesses have separately. If you're capturing installation revenue from an employee or 1099, then the buyer has to have a C license, or enough of the remaining employees do, and then finding a lender who will support. So we've actually had some sellers who've decided to, because installation was just a small percent of the gain, they would just not take the income for that. They chose not to take the income for that, get a referral fee from the installer for referring the business to show as a profit on the deal. And then their business is strictly retail sales. And it opens up to a larger pool of buyers. And we have experts in the contractor license, how to work around, get multiple employees, get those licenses, get those certifications up to it, rather than being all about the seller, all about John, for example. We need to make sure that that's there. So really, I think the last slide, let's see. So I've had a buyer come in, a looky-loo, coming in, and they're working with a seller and thought they might sell the business. We took the listing, gave the seller a 20% discount on the listing on our commission if the buyer materialized and closed the business in 90 days. Found out in 30 days using our process that the buyer was a looky-loo, wanting to just get competitive information to open up their own business. Vetted that out. The buyer went away, and we got multiple offers to where the seller sold the business within 4 months. So we were glad to do that. Recurring income, confidentiality is very key. And really, this ends the part of the open deal where business sale transactions have many complexities. Every deal's different. Gaps need closed, and have your trusted advisors guide you to closing. So really, I'd like to open this up. I see a few more questions here. Let's see. How do we market this discreetly? Well, that's a great question. We market this with some businesses are marketed discreet, the majority of them that are making money because they don't want their employees and customers to know. So we create blind ads and market the business. We may not say the exact city, we may say a county, put some general info as a teaser, see if they're interested in it. And we also have buyers fill out a non-disclosure agreement and a little bit of a buyer profile to help us understand what related experience do they have, what's their financial, how they're going to support the deal, do they have the down payment, what their income expectations are, just to see if it's a fit before we send them additional information on specifically what the business name is, where it's located, any P&Ls or supplemental data to support the due diligence the buyer needs. Good question. Aside from keeping meticulous records and cleaning up the appearance of the place, are there things I should consider doing to influence a sale in the future? Yes, I think having your financials be up and above board. You never know when a pandemic will hit. Being prepared, the people prepared were able to close deals in Q3, Q4. You never know what the health brings. Sometimes you're planning to go to a family member, and the majority of the time that doesn't pan out. They may not even want something to do with your business, even though they've been in it for a few years. That's good. Let me try to understand this one. The business takes, so this question is to the effect of, if a business requires such hands-on management, is there that consistent attention really, does that make that business so unattractive? And it really depends on how much cash flow it's generating, but really how transferable is that risk from that seller to the buyer, and how do they believe in it? So distributing that, empowering some of your people, they're going to understand. They're going to know, well, how many vacations did you take? How long was it? Who handles problems when you're away? It's something to manage. You know, people don't want to buy a lot of people don't want to buy a job. People want to buy a business. There's both categories of people, and we need to look at if business received a PPP loan before the loan is forgiven, can the owner sell the business? There was that's a great question. PPP loans are the SBA put out a ruling or a letter out October 2nd. Feel free to contact me. I'll be glad to send it to you or the office. And this letter gave guidance on how to deal with the unforgiven loan. But yes, you can close transactions. Lenders have their own policies. The SBA has their rules. We are seeing that happen. And even the better news is the SBA's released additional guidance right now where we're actually starting to see PPP loans being forgiven. I was just contacted last week by one of my clients who just got that out of the way and wants to go to market. So I don't know how we're doing on time right now, JC.
We've got about 4 more minutes.
Okay.
We'll answer a couple more questions. And by the way, folks, if you need to drop off at the 12 o'clock mark, again, this is recorded and you receive that at the end, so we can continue on forward if we need to, if we've got some imperative questions. The one comment I do want to make, though, with all the factors that you mentioned, the term, the risk, et cetera, you know, folks, you know, John, LaMay, Helen, and I, and the rest of our agents, we're happy to talk to you, give you some advice, give you some insight so you can start preparing. But when you're ready to put your agents to work, that's what our in-house broker's opinion of value or external valuations are for, to help you mitigate these things and help you plan. So valuations aren't just there to put your business directly on the market. Sometimes it will tell you that this is what your business is worth now, and with some certain changes, we can mitigate some of these things and increase the value of your business. So remember that we do have that product in-house. And so when you're ready to put your agent to work to get some real actual facts about your business, you know, think about those broker's opinion of value products and valuations that we offer here at Sunbelt.
So really your next step is call us for a free consult. Why lose out? Get prepared. There's things that we can look at and point key risk factors that maybe you could shore up the gaps. And I think that's really what I have. So I'll turn it back over to JC and Alan. Thank you.
Yeah, thank you, John. I think let's distribute that SBA update on COVID, not COVID, the PPP loan. Let's share that with the participants today. See, that's a great benefit to everybody who registered today.
Okay, we'll do that.
Okay.
Thank you. Okay.
Sure.
Well, have a great day. It's make it a great day, and we look forward to working with you and answering your questions.
Yeah, thank you again.
Okay, thank you, John.
Yep, thank you, John.
Yeah, and,
my pleasure. You bet.
Special thanks to JC, our operations manager here.
Yeah, thank you, JC.
Yeah, I look forward to receiving all of your calls, folks. Talk to you soon.
Okay. Bye-bye.
Bye-bye.